started until he gets here. That's what's going on there. You ready for taxes? Are we ready for this? All right, taxes. Let me put this up on the screen. All right. First of all, I don't know if you've noticed, or probably some of you, noticed or not noticed. Whoops. It's a new tax form this year, and it's the first year that we've ever seen this kind of a tax form. There's page 1, there's page 2, and it's using the same amount of paper as the old form, but there are 2 major parts of it that have been removed, only to be put in what's called, where am I here? Schedules. There's a Schedule 1, Schedule 2, Schedule 3, Schedule 4. But really, these are parts of the tax form that were there. They just now moved to a schedule. So, which, if somebody usually doesn't have any of these different kinds of income or any of these adjustments, then they're probably happy about it. It's on a different form. I only look at this. It makes this short little form now much easier to fill out. But you're still, if you have some those in either of those sections, you're actually filling out more paperwork. So what they have done to make it easier, I don't know if it really is that much easier. Now, there's been a lot of changes. This is the first year. See this part? Let me blow this up a little. Right here where it says dependent, this first section, by the way, is your information. Where you live, your social security number, your address, and if you have dependents. Now, I don't even know why they're asking for dependents. This is the first year ever that you do not get a deduction called exemptions for your dependents. I did not know this was part of the tax change until just last week when I got into this to get ready for this lecture. I couldn't believe it. I mean, do people realize what that means? The trade-off is, let me go here. I know I'm jumping all around. I'll get back on track. It's just, this part's just unbelievable. The trade-off is, this deduction right here, called a standard deduction, that says $12,000, that's significantly more than it used to be. And if you're a person with no children, you're really happy about that. But if you're a person who has children, you should be upset because the exemptions are gone. And so where you would usually have, like let's say it's 5,000 or 6,000 more, you're getting like 5,000 for each child. Or in my case, there's a whole bunch of people my age that are now having to take care of their old elderly parents because they're living so much longer than they used to. And in my case, my stepmother has dementia, so I had to take care of her for a while, a little bit. And that was a dependent on your taxes, and you get to write a deduction just like you had a child, and that's gone. That's a big deal. If you have more than one child or more than one person you usually would be able to do a deduction for, it's gone. And you should have raised heck when this whole tax plan was being voted on. This is crazy. And it's almost like they were saying, we think you're having children because you want that tax deduction, so we're going to take that off of there. Wow. Anyway, I'm shocked. Hey, I don't have children, so I shouldn't complain, but I would say most people have children who are paying taxes and working full-time, and they should be upset about this. All right, so you fill out your information, social security number, blah, 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 your address. Everybody knows this part, right? Your dependents, for whatever reason, because, you fill in the dependents, maybe in case you're going to take a child care a tax credit or something. So this first section, we'll call it the information section. There's that one. And that's the whole first page. You sign it. And then you got to sign it again on the back, which is the first time I've ever seen that. So now we'll go to the back. Here's all the nuts and bolts right here. Line 1, your wages, salaries, and tips that you received W-2s for. Right there. Line 2 are other incomes you might have. Tax-exempt interest would be right there. Taxable interest is over here. Qualified dividends here. Ordinary dividends here. Your pensions and annuities here. The taxable amount of those pensions and annuities. That's right. After you retire, and you're getting a pension, or take that back. You guys are too young. There's a whole bunch of people still working for companies that do pension plans that's not like a 401k. Like if anybody grow up in a GM family, General Motors family, parents or something, a lot of you, okay, so you know what I'm talking about. General Motors used to have, I don't know if they still do this, but they used to have this pension thing. My parents were General Motors employees. So when they retired, they get a certain amount of money every month for life. That's how a pension works. And so what a lot of people don't realize is these elderly people who get these small pensions, it's not a lot of money. I mean, it's less than what they were making when they were working. But it's taxable, federally. We happen to live in the state of Michigan where the pension's not taxable statewide, just federal. Same with Social Security. Social Security, if you're an old person, you're getting Social Security, you're not getting much money. And most people are only getting like $1,000 a month is all Social Security. But it's taxable. Not on the state level. When you do your state form, the Social Security is not taxable. So that's great. But federal is taxable. A portion of it, most of it. Now, here's all the other incomes, line 6, where you have to go and open up this this Schedule 1 to put those. Now, this is the first year we ever had to do this, but I have to do, for example, where is it at? Where's my income from? Right there, rental real estate. When the housing crash took place, I bought a bunch of foreclosures. I was renting them out. Now I got them all sold except for one left. And I'm still getting, and I had still 2 left, I guess, last year. So I got to claim the rental profit on line 17. On this form now, it's no longer on the main form. And then unemployment is taxable. Anytime, if you've ever gotten unemployment, one of the first questions they ask you is, do you want tax withheld out of it? Because you're going to have to pay taxes on it. And a lot of people say no, because they need as much money as they can get. Well, all of a sudden when they do their taxes, they usually get maybe a refund, and now they owe, because they never had taxes withheld out of their unemployment, or their refund's a lot smaller. So all of those are on this side. Business income. I do want to point out, I encourage most people that when you graduate and you get your full-time job and you're working, that you consider having a side business, just a little home business of some kind. And the reason is, it's because it's really kind of tax-free money. When you fill out form, what's the form? They're calling it Schedule C. You know, wherever I lived after I graduated from college, I always had this little side business going, which was usually next to nothing. But anything I made off the side business would be tax-free, because when you have a little business going, and you're using like your spare bedroom at your apartment as an office, you calculate the percent of that bedroom to the total square foot, and you get to take that percent of your utilities and subtract it from your revenues from your business. You get to take that percent off your property taxes and subtract it from your revenue from your business. These are things you would have to pay anyway if you own a house, or the property taxes, or if you pay rent. The certain percent of that rent, of that square footage of that room, is to be taken off. You end up having so many things by having a home office in your own business, whatever your hobby is. Like someone asked me, hey, I love cars, I read about cars all the time. I said, buy and sell 3 to 4 cars a year. You don't have to have a dealer's license if you don't go over a certain amount. And make that your side business, and look at all the things you get to write off. Any money made on the side little business will be tax-free, and you're even allowed to have a loss. So you can even have a loss and pay less taxes than your other thing. Now be careful, there's some rules on losses where if you had it 3 years in a row, it's something, something, something. So read the rules, but I took advantage of it, and I always have a little side business, whatever it may be, to do this. I remember one year, I'm sorry, it just popped in my head, I think you're going to find at least a little comical, is that I couldn't think of what I wanted to do for a side business, but then it was either through conversation or something I read. I said, you know, it'd be really easy to transfer people's old home movies. Now, this is a long time ago, onto VHS. Because everybody had these old Super 8 and 8mm movies and those 32mm. So I just started putting little ads up here and there. Internet didn't exist yet. I used the newspaper, I think, I don't remember. And then word of mouth started taking off, and then I went to every video rental store, the VHS old video rental stores, and almost every one of them would put my sign up, and they would advertise it, have people bring their home movies there. They'd give me a call, I'd go pick them up, transfer them, and I would charge them 3 or 4 cents a foot. They charged the customer 5 or 6 cents a foot, and being the middle person, they would just make their little bit of profit. And so I was getting so busy, I even hired someone. This is a little side business, I want you to remember. I was getting so busy, I had to hire someone to do the transferring, because now it was impeding on me, being able to do my regular job. But it was all tax-free money, because I was using the spare bedroom, and I could write off the heat, the utilities, the internet didn't exist yet, so I couldn't write off the internet, but whatever percent of your internet you spend for the business, you get to write off part of that. You have so many deductions, miles that you drive your car to go, when I go pick up the home movies at a video store, that mileage times whatever the cents is per mile that they put in the instructions, you get to deduct from the income from that side business. And so there's times where I almost show almost no profit from the business, all tax-free money that I'd have on the side. Just a little side thing, and allows you for these things, utilities and rent and whatever that you're going to pay anyway, to be able to use that to, why not subtract, to be able to make some tax-free income on the side. This is after you have been at your job a while and you're starting to get bored. And usually the next thing is that you start to look for another job possibly, but instead get the little side business. Go ahead, sir.
Is there a minimal amount of income that you have to generate from that side business? Because I'm assuming it
I don't think there is. I'm not sure, but I've never known of a minimum you have to make. Don't get me wrong. I mean, you got to make something. You got to have revenue. One person I know did this was a long time ago, where they would take people's pictures and make a calendar out of it. She had to place the pictures on the pages of the calendar, and doing really well. Doing semi-well with that. And same thing, wrote off the office, all tax-free income on the side. When you get home from work. Anyway, so that's that one. Just popped in my head. So there's your sections for income, all right there. And then, what used to be the next section called adjustments. Now these words I'm telling you are important because when you have a quiz, and you're looking at something, it's a lot easier to know what section to look at to refresh your memory on what would be done with this question. So there's income, and now we're looking at adjustments. So there's your personal information, income, then adjustments. And adjustments, we're going back to the same new form, right down here. And these are kind of the items. And the reason I want to make sure to point this out to you is that here, if you have a student loan and it's not subsidized, that means you're paying interest while you're going to school. If it's subsidized, you're not paying any interest. But once you start paying interest on it, here's where you get to deduct it from your income and not have to pay taxes on that portion of your income that you pay the student loan. And there's another one for tuition. We got to find it. Anybody see it? Not the educator expense. It's tuition. They moved the tuition to a whole nother place. Oh, that's under credit. So we'll find that because have you ever gotten, I think it's called a 1099-T? Is that the form, or the form that tells you how much you spend in tuition? Has anybody ever gotten that form? You're the only one? Oh, you've gotten one, Elizabeth? Okay. If you haven't gotten one, you're out on your own, or at least give it to your parents if they're paying your tuition. Whoever is not covered by financial aid, the part of tuition is tax deductible. That's what that form's all about. So you want to take advantage of that because it really increases your refund. And the only other one, if you have your own little business and you're only working for yourself, you have what's called the self-employed tax. I want to make sure you realize what that is. This one, and there's another tax for self-employed. I get them mixed up, but this one, have you ever worked for somebody and looked at your paycheck and you notice there's Social Security and Medicare being withheld out of your paycheck? Well, if you figured out the percent, it's like right around 7.5%, a little more, like 7.6%. For both, the two of them added together, Social Security and Medicare. What you don't see is every time you get paid, and that 7.6% being withheld out of your check to be sent in for Social Security and Medicare, the employer has to match it dollar for dollar, the exact same amount, and send it in with your amount. So there's twice as much being sent in than you see in your paycheck. When you work for yourself, a sole business that you are, the employer, you have to pay, when you're paying yourself, you have to pay the employees and the employers Social Security. So instead of 7.6%, it's like 15.2% or something. So this is where a lot of people who open their own business, or a lot of people in their first job will go work for somebody who says, we're going to subcontract you. Well, when you're subcontractors, that's like owning your own business. And you got to pay both the employers and the employees, Social Security and Medicare. And when you're negotiating on what you're going to be paid as a subcontractor, and you don't realize an extra 7.6% is going to be taken out when you go do your taxes, that will be the moment you go, oh, I under negotiated this pay by at least 7.6%, because no one ever knows until they do their taxes, then another 7.6% is gonna be owed on all, their whole year's pay. So that's what you gotta watch out for, and the job market is really good right now. But if we have an economic slowdown and the job market slows down, a lot of companies will offer subcontracting to try to test you out, or they just want to avoid taxes or whatever reason. Like any marketing majors or anybody think they might go into sales at all? A lot of sales positions, companies will try to subcontract you. And so that's when you got to watch out, because you pay a lot of extra tax that you don't realize until you're in the job over a year. All right, so that's what that one is. So there's that. Next section. So there's where Schedule 1 will show up right there on line 6. Now, see this adjusted gross income? That's also called AGI. It's referred to a lot. This is a very important number. Almost anything you're applying for that has like an income calculation involved. Is there anybody that doesn't have health insurance? Here's a good example. Everybody has health insurance? That's great. Very rare. If you don't have health insurance, Genesee County has what's called the Genesee County Health Plan, which is like a great safety net for people who don't have health insurance. It actually gives no excuse for somebody not to have health insurance. You just go to the Genesee County Health Plan, which is on Linden Road by Corona, and they're going to ask you for your taxes, and they're going to base whether you qualify for it on the adjusted gross income. That's how it is for almost anybody that is using income as a qualification. This is the number they base it on, adjusted gross income. So it's before you have your deductions, and it used to be before you have your exemptions, but exemptions are gone. It doesn't matter how many children you have, but there's still deductions. So there's adjusted gross income. Now, next is your deduction I was talking about. The standard deductions are much higher than they've ever been because exemptions are gone. Now, itemized deduction is this. Here's the sections. Medical and dental expenses not paid by insurance that you had to pay out of your own pocket. There's the first part. Taxes you had to pay. The big one is if when you own a house, where's property taxes? Real estate taxes. Right there, that's a big one. You know, a lot of people's real estate taxes are like between $2,000 and $4,000 a year. So right there is a big deal. And then, you know, state and local taxes, what you paid in state and local taxes, what was withheld out of your W-2 even. You could even just put that number. And then the next section is interest you paid on your home loan. Home mortgage interest and points, right there. Now, before, I used to advise, hey, if you're thinking about buying a car and you're looking at car loans and the interest rates just don't make sense to you on a car loan and you want to get your payment down, consider a home equity loan. You can spread the payments over a longer period of time. It has nothing to do with the car. And you get to write off the interest. Not anymore. This is the first year home equity loans cannot be interest cannot be put on here unless you are ready for an audit and can prove you spent all the money on improving the main residence you live in. Then the interest is tax deductible. But that's the only way now for a home equity loan. If you used it for anything else other than improving your primary residence, you can't put it on here. And that's kind of a big deal. A lot of people use home equity loans specifically because they could write off the interest on here. And then the next section, gifts to charity. I suggest 250 or unless you have really good documentation that proves you really did gift to charities more than 250, I wouldn't go over it. Because even in an audit, you don't necessarily have to prove too much up to the 250. It's after that that you've got to have documentation. I want to make sure everybody realizes you will, 90% of you will have at least one audit in your life. So always be prepared because you won't see it coming. And I've been through 2 already. Personally, companies I've been through many. But personally, I've been through 2. It's not usually because you did anything wrong, because something unusual took place on your taxes compared to maybe a previous year. Something, and in my case, when you leave a company, you can transfer the retirement plan from like your 401k to an IRA at a brokerage. And if you take it out personally, you have 60 days to get it into the new one, or you can do a direct transfer. Well, I didn't do the direct transfer. I took the money out, and about 20 days later, I put it back in the other place. Because I did that, that clicked the software they use, clicked an audit, and that's an example of where you're going to be audited even though you did nothing wrong. And what I had to go through to prove that that's exactly what happened was unbelievable. So that's what an audit is, pain in the rear. No matter how honest you are, they're going to keep asking for more documentation, more documentation, more documentation. And I always suggest, there's always in small little print, it says if you want some free help, there's a toll-free number, and I've learned my lesson, always call it. You get the free help, even if you think you don't need it. Because they know exactly what to do, and then they can get it done and over with. Right? A lot faster, you can do it on your own. Casualty and theft losses. This has changed a little bit too. But this used to be, and I know it's changed a little, so I don't remember what the changes are, but I had a fire at one of my rentals, and I had a $1,000 deductible, and the insurance covered everything except for the $1,000 deductible, but that year I got to put the $1,000 on here, so I at least, whatever tax bracket I'm in, I got to save that much out of the $1,000 back as a refund. So like if I'm in the 25% tax bracket, I got $250 of it back in my refund because I itemized it, so that's a nice thing. Theft and losses from fire or you got broken into. And then that's it. Now if you do all of this and you follow these little calculations and this adds up to more than these standard deductions, you get the choice at that moment. Do you want to take the standard deduction, whatever that amount is, in most cases $12,000, or do you want to use your itemized? Because if they add up to more than $12,000, you will obviously want to use the itemized. The itemized only had to add up to more than like $6,000 before this year. So you can see this doubling the itemized deduction. It hurts all kinds of people who may have only had, you know, $7,000 or $10,000 in expenses that are on that list. Now they can't even use the itemized deduction because they have the standard deduction ends up being more, which is fine, but I don't know what to say. Yes, it's hard to explain. The last, or not the last, the next item, line 10. This is this one right here. Taxable income. So I want to make sure you get this order. The personal information, the income, then there's the other income and adjustments, then there's the deduction, standard deduction or itemized, and now taxable income. This number is what your tax is calculated on, right there. Not the adjusted gross income. That's done for a lot of things you apply for. But the taxable income is what your tax is calculated on. And that's line 10. Now, most of you will go, I forgot to open up, but you'll go to that chart, and you'll take that taxable income, and you'll figure out which column you're in, and you'll line up, and you'll see how much you owe. But, this is this is the hardest part of today's lecture, but this is really, you have a choice, and you'll always save a couple of dollars if you decide to calculate your tax instead of using the table. Now, I want to tell you, I get this a lot. Somebody will say, oh, I'm about to go with a 22% tax bracket. It's December, I'm going to go over 38,700. They're all worried, oh, I'm going to be in the higher tax bracket. What do I do? I don't want to go over this 38,700 and get that. And what they don't realize is that just because you move to another tax bracket doesn't mean all your income is going to be taxed at that rate. Only the portion that went over that is taxed at the higher rate, but just that portion. So if you made $40,000 for the year, only the part from 38,701 to 40,000 is taxed at 22%. And don't forget, it's the amount after deductions and adjustments. The taxable income is what you're comparing to this. So let's do this. Let's pretend someone made 40,000 and somebody else made 100,000 taxable income. All right? No matter which income, whichever bracket you're in up there, we're all taxed the exact same way at 10% for that first amount of money we're making. No, this could be 400. And that person, as well as that person with 40,000, are paying 10% on whatever column they're in, we're gonna use single, on the first 9,525. So 9,525 is getting taxed at 10%, 0.10, so that's 952.5. The next part, and I look and I go, okay, we're all of these fit here, so they're all paying this first $952.50. The next section, from 9,526 to 38,700, subtract these two numbers and tell me what's between them. That portion's taxed at 12%, times 0.12. You ready? Hang on. 38, 28, 28, 29, what? 29,174. Whoops. 29,174. That's the amount from here to here by subtracting these two. That is at 12%. Take 29,174 times 0.12. 300, 500 even, and 88 cents. Okay. So, this person, all three of them, are paying that exact amount if they're single filers from that section. No matter what your income is, we all pay the same tax. Now, we're going to focus on this person right here because they're stopped in this bracket. We don't calculate the tax all the way on 82,500 to 38,701 because this person's taxable income is at 40,000. So just from 40,000 to the bottom of that is 38,701, 38,701, and that is going to be multiplied by the next level, jumps all the way to 22, 10% extra on just that amount, 1,299. $1,299. Oh, I'm sorry. That's beautiful. Where's my eraser? This equals 1,299 times 0.22. 10, 20, that's 100, no, that's 260, 285, 78 cents. Now, this person who has a taxable income of 40, you add these three numbers, that is their tax. Right there. The only part that they have to pay this higher percent is just this 1,299 because they went into the next tax bracket. Where so many people think if they go into the next tax bracket, all of it's going to be taxed at that higher percent. And that's a myth. It's not true at all. Just that little bit is over. We keep, with the 100,000 person, we obviously would figure out this whole amount times 22%. And then the next bracket from 100,000 to 82,501, that amount had 24%, but just that amount. And we'd add all those. For the 400,000, this would be the full amount, full amount, full amount, full amount, full amount here, but here we go from 400 minus $201, and just that portion's taxed at 35%. Anyway. Okay. So what these added up to 35, 36, 36, 1, 2, 36,000, no, 3,600 something. 3,600, what is it?
4,739.
Oh, wow, I'm way up. 4,000, I didn't realize. 789? 39 point something something. That's the total tax that would be on line. That's the tax that would be on line 11. Now, you go to the 40,000 in the table, it will be more than this by a couple dollars sometimes, depending on where it lands in the bracket. So, you know, $2 or $3 means that much to me, and I'll do this calculation because I'm just that cheap. Right, making sure you guys know that. How we doing? You okay? You gonna make it? Let's get to the PowerPoint, see what we missed.
Is that earned income?
We mean earned income credit?
You mean all of those tax?
But that is whatever lands on that line item taxable income, which is right after deductions.
Okay.
Whatever that amount is, that's what all this tax is based on, or the tax table if you're using it. That taxable income, which is right after the deductions, which was line, was it 6 or 7? Line taxable income is line 10, excuse me. Line 10. And I want to tell you, I know for sure you have some questions coming up in your future asking you, here's the taxable income, what will be line 11 tax amount? Manually calculated. This is the hardest part of today's lecture. That's why I'm making sure you get this. You want me to show you another one or not? Is we good with this? What if we're a married couple? Okay, let's look at married couple. Hang on. Let me go back. Okay. It's a married couple. And they may, to make it fast, I'm going to go to 60,000. So a married couple whose taxable income is $60,122. That number right there. Same thing, but now we're using the married, finally married, and we're going to take from the first 19,050 times 0.10. That one's easy. It's going to be $1,905. Just move the decimal over one. The next one, you ready, Jeffrey? 77,000. Oh, I'm sorry. The 60,000 lands in the next bracket. So you're not going to subtract this whole thing, just the amount they made that's in between here to the lower limit. So 60,122 minus 19,051 is going to be 39 or 40,000? 41,071 times 0.12, and then those two numbers added together would be the tax for the married couple who's claiming 60,122 as their taxable income. Does everybody see the process of how I calculate that? Which is also, there's an example in your book that's showing you this also. If you know, so you want to quick refresher. What was the total? Sorry. What was this one?
That one is
400.
4,928.
4,928 and some cents. 29. And then we got $6,834 is the total tax for this couple that had taxable income of $60,122. How's that? I've seen it twice, two different years in two different columns. Now, if you still find this confusing, please don't be afraid to email me, because I'll send you another example or even another example, whatever you need. So you can make sure and get this, because this is in your future. All right. What was that? That was our calculating the tax. So we did adjusted gross income on the tax form. Where's the taxable income and how important that is? Calculating the tax, deferred tax income, adjustments to income. We did adjustments to income, tax deferred income, the only thing we didn't talk about. Marginal tax rate. You need to know what marginal tax rate is. You'll see some questions that say, talk about the marginal tax rate. Here's my definition. Here's a couple that has taxable income of $60,122. If they would have made one more dollar, which would have taken them to $60,123, based on this information, at what percent? Wait a minute, we got to get these. Yeah, we don't need it, but at what percent would that next dollar, that 123, have been taxed at? That $1 would be taxed at what rate? 12%. And that what you found is the marginal tax rate is always what rate will the next dollar be taxed if they've made one more dollar. That's how I kind of put it. Marginal tax rate is what is the rate. So let's say a single taxpayer had $41,000 for taxable income, and now we're asking about $41,001. Single taxpayer. What will that one more dollar be taxed at, since we're already up to $40,000 in taxable income? 22%. Because it landed that since they're already in this tax bracket at $40,000, the next dollar would still be in this tax bracket, 22%. That's marginal tax rate. And that's the rate you use when you're making decisions, when you already have made enough to be in a tax bracket, but you're about to make a decision trying to decide if you want to pay taxes on that money this year or next year. And that's where knowing what your marginal tax rate comes in handy, because there's some people who say, you know, I sold something this year, it inflated my income, I want to put that off, I'll be in a different marginal tax rate next year, I'll put this off till January and pay a lower tax on it then, because I'll be in a different marginal. I had that situation when I sold a house, I made a lot of profit off it, and the year you sell it, you gotta claim the whole profit. So it looked like I had a bunch of income, and had I, did something else, the other decision, I'd have to pay the marginal tax rate. But the following year, I didn't have a house to sell, and so I'm in a lower tax bracket, and it paid off that decision. Now I'm gonna pay a lower tax. So I may have went from a 24 to 22. But where it really pays off is if my marginal tax rate were 22, but I wait till the next year, I'm about to retire. And so I'm only gonna get my pension and Social Security. Now I'm in the 12. If there's something in December you're about to make a decision, pay taxes on, sometimes waiting till January is a better decision. Because the following year, if you're retiring, you'll be in a lower marginal tax rate. It's the rate on the next dollar earned. All right. So the only thing we need to talk about is tax-deferred income. I can't remember why. Let's go to slide 6. Fresh on my memory. Tax-deferred income. Total income is also affected by tax-deferred income. This income, it will be taxed at a later date, such as IRAs and your 401ks and your 403bs. If you ever get your W-2, I forgot to open the example W-2 because I'm going to bring it up on Wednesday. But if you open it, you'll notice you have two incomes usually listed. Sometimes they're the exact same number and sometimes they're not. One income is how much you really earn and have to pay Social Security and Medicare tax on. And the other one is how much you earn after whatever amount was put into retirement out of your pay has been subtracted. And you're only paying taxes on that smaller amount on your W-2 because the part you put into a retirement plan, you don't pay taxes on it until later. So that's called tax-exempt income. And when I bring up the W-2 on Wednesday, I'm going to show you how there's two different numbers or where the two numbers would be so you can see which one's taxable and which one's not. They're either the same or the lower number is the one that you have to report on your tax form. Any questions? We're a little early, surprisingly. Oh, almost forgot. How can I forget this? Boom, right here. FreeTaxUSA.com is my favorite tax web page. The reason is I've tried out a bunch of them. And what I like about this one is the way they ask questions while you're doing the form. Very user-friendly. It's almost like you're sitting across from somebody who knows exactly the right questions to ask. Do you have any children? Do you happen to have a business going? It's just like kind of really good questions, very user-friendly. The federal form is completely free. The state form is not free. I've never paid those because they give you almost all the numbers that will be on the state form. You just have to print that and write those numbers down on the state form. You save, I think they charge $12. No, $15. So you'll save $15. Just do your state form yourself. But all the numbers will be there at the end when your federal form's ready to go. There's the numbers for the state. You just got to, I took a picture of those, and then I just put them all on my state form and filled it out manually. But this is the best I've found. Anybody recommend another one they find really user-friendly? Because I know there's several out there, but I've tried a lot of them. No one? Okay. TurboTax? They offer free now federal, right? And that's probably the most popular one, but by that time that they finally went free, I was already connected to this one, so I didn't try TurboTax webpage at all. Another thing I want to mention is, after you do your taxes, and I hope everybody at least takes an attempt, once you're out there in the real world doing your own taxes, you don't feel confident about it, and you shouldn't, no matter how well you think you can do your own taxes. Take it somewhere because every place offers a free look. So look at what you did, and I used to do this all the time, and then they'll say, if they find something that's going to get you a bigger refund that you missed, they'll ask to do it for you, which would be like $40 maybe or something. Where I usually say, here's $10, thank you very much, I just go home and make the change. Just so you know, a free look. Do it. Try it. The advantage of doing your own taxes is you'll start to learn exactly how taxes work. And you'll start making better decisions that will lower the taxes you have to pay. And that's kind of what that's all about, by doing your own taxes. And then you have someone look it over, and any changes, pay them just to make the changes. Saves you a ton of money. All right, I'll see you on Wednesday, we'll finish this chapter then.